Good morning or good evening, wherever you are in the world, and welcome to the Trailblazer webinar, M&A activity in the lifestyle hotel sector. My name's Eloise Hansen. I'm the editor at Boutique Hotel News. We are an online multimedia B2B site for boutique, lifestyle, and luxury hotels. One of the sponsors for today's session is Bizzon. They are a restaurant management platform, and Dominic Child is the Vice President of Sales. His details are in the chat if you would like to find out further information about Bizzon. Just to run you through some webinar guidelines, we're going to spend around 45 minutes in discussion today with our Trailblazers, followed by some time at the end to take any questions from the audience. So this is my call out to anyone tuning in today. If you have any questions, please submit these using the Q&A function, and I will get round to these as and when. And as a gentle reminder, this session is being recorded, and every single registrant will receive a copy of that recording by the end of the week. The second sponsor for today's session is property management system Elina, and we have a short video to play for you guys as way of introduction. And once again, if you'd like to find out further information about Elina, some further details have been popped into the chat. Now, here's our Trailblazers, and I'm going to invite each and every one of them to introduce themselves individually. And I'm going to move from left to right as per the PowerPoint slide, which means Hilton, I'm kicking off with yourself. Go ahead.
Hi, Louise. Thanks for having me. So I'm Hilton Foster. I'm a director in the debt finance team at OakNorth. OakNorth is a relatively new bank compared to some of the other lenders in the hospitality sector, been around since 2015. And we are a bit of a niche player. We like the hospitality sector specifically, as well as other real estate backed asset classes. And we're pretty agnostic as we approach it. We like big players, small players, the entire range. And we're open for business, and we're trying to build a book and build a name for ourselves as best we can.
Brilliant. Thank you, Hilton. And I'm coming to you next, please, Brad.
Hello, everybody. Hi, my name is Brad Korman. I am co-CEO of Korman Communities. We are a 5-generation, 100-year-old real estate company based in the United States. We operate 2 portfolios, an apartment portfolio called AV and a hospitality portfolio called AKA. We started as a serviced apartment platform through AKA and have evolved over the last 20 years into a full-service hotel company, including daily, weekly, and monthly stays We operate in most major markets in the United States, including Los Angeles, New York, Philadelphia, Washington, Miami, small property in Marylebone. And we just recently completed raising a $700 million opportunistic hotel fund, of which we've deployed about $200 million of those dollars, and look forward to talking about that with everyone today.
Thank you, Brad. And last but not least, I'm coming to Philippa next, please.
Hi, Luke. Thank you very much for having me and Louise. So my name is Philippa Goldstein. I'm the senior analyst at Knight Frank, and I focus on the hotels sector. And so at Knight Frank, we are one of the leading, we're a privatized company, and we are one of the leading real estate consultancy firms with a global reach. And from my perspective, from research and sector knowledge is integral to everything we do, and it supports our very active hotel agency and hotel valuations team. Hotel agency team being led by Henry Jackson and Karen Callahan heading up the valuations team. So we're very active, and we're finding there's still much to play for in this market.
Brilliant. Thank you, Philippa, and thanks to the other Trailblazers. So all their details are in the chat if you would like to connect and follow up on today's conversation. So if you haven't joined one of my webinars before, I always like to highlight some stories that I've published on boutique hotel news within the last, say, 6 to 12 months that all highlight or provide some background context to our conversation today. And just over the last couple of months or so in the UK, there's been some portfolio acquisitions from the likes of private equity firm KSL, which has acquired the parent company of the Pig Hotels. And we have independent hotel group Bespoke Hotels, which has just purchased Macmillan Hotels up in Scotland. On the merger side of the topic of M&A, Resident Hotels is expected to take over management of the Sleepers brand by Q3 this year. And as Philippa has just alluded to, the marketplace is starting to hot up with activity. And we've just recently seen PGIM Real Estate and a newly formed division of Cairn Group launching a joint venture to acquire, develop and reposition UK hotels in staycation and domestic leisure destinations. On the next slide, we have two very recent stories published within a day of each other, which highlight the attractiveness of the lifestyle hotel sector. Now, first, we have Singaporean Sovereign Wealth Fund, GIC, and Dutch pension fund manager APG taking a majority stake in the Student Hotel. Accor has also just entered into exclusive negotiations to sell 10.8% of Ennismore to Qatari investors. And as part of this deal, Accor is merging its stakes in the all-inclusive brand Rixos and restaurant operator Paris Society into Ennismore. So there is clearly a lot happening within the space and clearly a lot to come. So let's talk about M&A activity. And I want to kick off by effectively handing over to Philippa, who is just going to paint a picture of what's been happening in the market and some key hotel M&A trends. So over to you, Philippa.
Thank you. Well, given how hotels are trading assets, I think it's a good place to start by looking at trading performance, because it gives a reflection of what's been happening and, more importantly, what is potentially likely to happen in the months ahead. So I'm just going to take you through a few slides to be able to show you how things have been moving. The first slide that we have is on occupancies, and it ranges from January 2019 right through to May 2022. And the data is courtesy of Hotstats. So in this slide, it shows London and regional UK, and I'm also showing Golf and Spa and regional UK apart hotels, both quite prominent in the lifestyle sector. So you can clearly see from this graph the the outperformance of the service department market throughout the pandemic. And it's definitely around 9.5–10 percentage points above the regional UK market. What's also quite prominent is that since the Omicron variant was contained within the first couple of months of 2022, you can see the strong recovery in occupancy, and which just moved and was transformed as soon as the restrictions on travel abated. So compared to the same months in 2019, occupancies have moved a long way, and are only at, they're doing well in the sense that London is at an 83% penetration versus where it was in 2019, and regional UK is currently at 86%. So it's definitely moving in the right direction, and the recovery is well underway. The next slide looks at average room rates, and here again we've shown the same period of time, but we've reflected the average room rate to show an adjustment in the VAT, so it's at 20% throughout this period, and it's further adjusted to reflect inflation. So from these graphs you can see really that the resilience of the average room rate has been strong, and unlike in previous economic cycles, it's been the sector has managed to maintain its average room rate. So versus May 2019, the regional UK is actually showing 2% growth in the average rate, and London and a staggering 14% outperformance compared to the same month in 2019. So what's driving this? Well, it's the inflationary market is helping, but also it's a combination of different factors, and the overseas market is definitely returning. The US market is considerably much stronger than, and it's 1.4 million visitors, for example, in the last month. So it's definitely healthy and strong, and other overseas markets are returning. Middle East is improving. But the average room rate, which previously historically was a strong gap between domestic and overseas, has narrowed. So the domestic market is showing that there's healthy demand for the transient leisure market, and it's really allowing average room rates to boom. Moving on to the next slide. This next slide shows RevPAR penetration, and I've shown it here by subsector, so all the different data sets that we have from Hotstats, and it shows different data sets for regional UK and for London. And we've taken the May 2022 and looked at how well the RevPARs are achieving versus the same month in 2019, showing actual RevPAR today and also when considering inflation, or adjusting for inflation. So you can see there are some star performers here, notably the London luxury market and the service department market. So London's luxury market has grown by 21%, and that is driven really by its average room rate growth, whereas the service department market, for example, as you saw earlier in the other slide, is really driven through its strong occupancy, targeting longer lengths of stays, such as the relocation business. So moving on to the next slide. whilst not to go into too much detail, we could have a whole session on just trading performance. But I think it's important to reflect some of the pressures that the operators are under. So utility costs being one of the major topics of discussion of rising costs. So in this slide, again, to pinpoint the differences in how prices or expenses has moved. So we show the percentage, utility costs as a percentage of total revenue, comparing May 2022 to May 2019 on a per available room basis. So on average, London's utility cost is approximately 3% per available room, 3% of total revenue, and utility costs for across regional UK are approximately 6%. So there's been definitely some shift in movement, as you can see. Then the final slide that we have on trading performance focuses on profitability. You've got profitability here for showing London, regional UK, and London luxury hotels and extended stay. And it shows the penetration of how hotels are performing, how the data sets are performing versus 2019. So, and it shows a month on month, the recovery month on month. So you've got, so you can see the resilience since hotels have been allowed to reopen, and the London luxury market in particular driving forward. So you can see the growth there, and London, for example, in May 2022 achieved a GOP margin of 33%, whilst regional UK has a GOP margin in May of 26%. There's a slight blip in April for London, and I understand that's partly due to where Easter fell this year, but also the return to the full rate of 20% VAT. But it shows the strengths of the recovery post-Omicron, and that the having a strong top-line performance really does help drive the bottom line. So in a high inflationary environment, driving revenues is as equally, or if not more important, as whilst having a tight control of your costs. So really, it's all to play for in driving your revenues in this era. And the final slide, which moves away from trading performance, but focuses on transaction volumes. And so basically, this slide here is putting the transactional market into context over the period of 15 years or 17 years actually, and shows that the traumas and also the lows and the highs of the transactional market, but where you can see lots of highs, and it's a very cyclical market, hotel transactions are complex and they take time, and that's what's definitely happening in today's market, and the level of due diligence that's required to undertake these transactions is possibly at an all-time high. Whilst economic factors often do dictate the level of transactional hotel transactions that take place, it's also the availability of supply is definitely a strong influence on the transaction volume. So in 2021, Knight Frank, we recorded approximately 4 billion of hotel transactions, which shows to be most resilient during what was an operationally challenged year, and of which over half of the transactions took place in Q4 of 2021, and that strong flurry of transactions did continue into 2022. The pandemic, I think, was definitely a catalyst for hotel transactions, and of of the approximately 50% of regional UK transactions took place in resort and coastal and rural locations. So again, it just shows the emphasis that's placed on the lifestyle sector and the importance of an experience. It's a structural shift, if anything.
With that in mind, Philippa, I mean, thank you for the presentation and just highlighting what's been happening in the market. But what would you say is the current sentiment right now? And I'd like to add on to that question whether you think we are eventually going to see that distress where I know anticipations of distress were quite high at the beginning of this roller coaster ride that we've all been on, though it hasn't quite materialized. So Philippa, back over to you. What's the current sentiment in the market, and do you think we will see that distress?
Well, 2022 got off to a strong start. We are recording approximately 1.75, 1.8 billion pounds of transactional sales for the first half of 2022. And from a Knight Frank's perspective, we remain very active. We have 13 deals in legals and a pipeline of transactional activity probably worth around 180 million pounds. So at the moment, things are still looking bright, which kind of suggests it shows that the trading performance is strong, and investors are still very they're certainly very favourable, looking very favourably still at the sector. So I think availability of stock remains a challenge, although the type of investors there's a broad range of investors, although the depth of investors might not be as much as it once was due to the economic, or the increased noise of the economic situation. But whereas I understand in other sectors such as retail and logistics, for example, they have seen a cooling off in prices in their sectors of as much as 10 to 15%. Personally, we haven't seen that here in the hotel sector. Prices are stable, and the shortage of supply combined with the strong trading is helping keep prices where they are. So I think there's an increasing length of time as getting deals completed, but that's also a dynamic of the debt markets coming back in, and that itself is taking time because it adds another layer of complexity with hotel valuations required. But in effect, increased debt to the market will aid liquidity and support the transaction market. To answer your question about distress, I personally, yes, there's always going to be investors that are looking for distress, but I think there's going to be some casualties in the market who are operationally challenged or underinvested, but I think it's going to be a similar trend to what we saw in 2021, where there was people that are choosing to exit the sector, so retiring. There's going to be potentially more forced sales, and the banks will be leading towards encouraging people to reduce their level of indebtedness, and so you will see maybe more refinancing and greater asset disposals or selection of disposals. So, but distress, I still think is not imminent, and it's not necessarily going to be in the volumes that certain people expect. So given the current trading performance and the ongoing strong transient leisure market, there's the trading performance is mitigating a lot of the pressure that maybe the banks might otherwise put on owners. And so given it's a recovery and an upward curve, despite the pressures on the economic that you hear on the wider economy at the moment, we're not seeing, with the trading picture is very different to the story you would hear in the press for the wider economy.
Thanks, Philippa. Thank you. I'd like to bring Brad into the conversation here to share your insights on the North American market. I know that AKA has launched if you like, a JV with Electra America, and I think the first acquisition I covered of yours was the Roger, with a fantastic discount. So are you seeing these signs of distress in North America?
Well, I will tell you, and I think Philippa touched on so many interesting points. We were, like everyone else 2 years ago, very nervous, very surprised, very anxious about what was going to happen, right? We grew up in a world of supply and demand. When you had vacancy, you would lower your rates and you would fill up. And when you were filled, you could then raise your rates more, or I'm sorry, you would lower rates when you had vacancy, you would fill up, you got filled, you would raise your rates, and there was supply and demand balances. There was a point during the pandemic where I could say to you, listen, come to New York for $5 a night, but you can't go shopping and you can't go to a show and you can't go to a restaurant. You might not feel safe in the city. You can't really get around on public transportation. You can't go to anyone's office. So do you want to come for $5 a night? And you would say, Brad, thank you very much for the kind offer, but no, I'm not coming. So there wasn't a price at which you would come to a hotel. So there was nothing there. And we just didn't know how long that would last for. And so as we built occupancy into 2021, offices were still only 20% occupied. And so there wasn't a lot of international travel. It was still very nerve-wracking. Here we are 2 years later, and I will tell you, we are as surprised as anybody about our performance. We are filled. We are 90% occupied in markets. We are raising rates. We are having huge success. And we're able to grow our platform in a time when we just didn't think 2 years ago that would be the case. And we thought there was going to be a lot of distress. And Hilton can touch on this. We thought lenders would have been putting much more pressure on their borrowers to sell or transact. And we haven't seen that as much. We've made some opportunistic buys through this joint venture with Electra. We've purchased 5 properties in the last year, a 6th under contract. But frankly, we have another $500 million US to spend over the next 12 to 18 months. So I have to buy another 12 hotels, and we have to do it in a way that makes sense. We can't be operating as if we just have a pocket full of money and can buy anything. Everything has to make sense. So where we're seeing distress, where we're seeing trends in the US and North America, that's changing. It's market by market. We saw people leaving California, leaving New York, leaving Chicago, going south. They were going to Florida. They were going to Texas. They were going to Arizona. And those trends are still in play, but yet New York has filled up again. And so there's a balance of what's going in our market. And I think the pressure, the distress will come from some of the topics just mentioned. It will come from the access to the ability for people to get debt, to refinance at the same proceeds. It will come from people who are looking to rebalance their portfolio. Operationally, we feel a lot of the same pressures on the expense side, including utilities. We have it with payroll. We have it with the ability to cover real estate taxes, all the things that we have to do in our properties. And then the platform, how we bought opportunistic hotels. Opportunistic, buying for us meant, some properties were in physical distress, some were in markets that were challenged. When you go major renovation program, the Rogers is a great example. It's $1 million renovation. We were fortunate to start and buy our supplies early enough, but new renovation projects that we're going through right now, you have to relook at it because costs are anywhere from 30 to 40% higher. Furniture that used to take 12 weeks, we're now being quoted 26 weeks. And you feel fortunate if you get it in that time frame. Labor, finding people to actually do the work has been interesting and challenged. So now we look at what we're buying and do we have the ability to get the renovations done in time? You know, I don't mind being a little slower in Miami in the summer, getting the work done, but I can't miss fourth and first quarter. And same in New York. I don't mind if I'm doing more work in the first quarter, but I have to be open second, third, and fourth quarter. So we try to figure out how we get the work done in a way that makes sense and allows us to be open when we need to be open. And so far, knock wood, we've been able to do that. We've been successful, but it does change how we look at properties in our acquisition and our pipeline. Are we focusing on properties that are newer versus properties that need more renovation work? And balancing that, Eloise, has been something that has been interesting for us, and how we go about that is part of the challenge.
Mm-hmm. Which brings into conversation here, I suppose, anything around ESG. I know when you start to look at buildings and you weigh up whether you do a new build project and kickstart that development, or whether you take an old existing building, renovate it, repurpose it, reposition it. So would you say then, Brad, that in agreement, I suppose, with what Philippa was saying, that deals are taking slightly longer with the amount of considerations that you now have to, well, consider when you move into these deals?
Oh, she's absolutely correct. Everything takes a little longer. There is no such thing as plain vanilla these days. Everything has a little bit of a story or a little bit of a process to go through, especially when you're buying hotels who may have been encumbered with a long-term management agreement and you're working through those issues. If there's labor issues, you're working through those items. If you're doing renovation, you're figuring that out. So all those factors come into play, and then you're putting the debt together and you're trying to put all the pieces together. We're fortunate right now in that we've raised a fund, we have committed capital, we can move very quickly. And I think one of the advantages for us has been during this time, you know, when someone's going through a tough time, they don't necessarily want to have it be public news. And so they'd rather, you know, have a transaction where they can deal with somebody privately. They know that there's a certainty of execution, and that whatever's happening is going to happen in a confidential nature. So we're able to come in, move very quickly, provide that certainty of execution, and be able to execute and keep things moving forward for groups who are looking for that kind of privacy.
Brilliant. Thank you, Brad. Now, it's already been touched on in this conversation, though we haven't quite dived into it in great detail yet, and that is the access to and cost of debt, which brings me on to Hilton. I mean, how is inflation impacting the access to and cost of debt?
It's a good question, because I think, you know, in the hospitality sector, inflation impacts everywhere. It inflects on ADR room rates, you know, at above the revenue line. It impacts below the revenue line and cost and utilities, and below the operational kind of profit line. It impacts on the cost of debt. So, you know, if we were sat here 6 months ago with base rate at 0.1 and now it's 1.25, that's a massive difference in the cost of a facility, a loan facility for, you know, for a hotel asset to suddenly support. So we have to, you know, as a lender, you have to take all of that into account. Your actual analysis is not too different to how we would look at any deal. You look at the cash flow, you underwrite a level of cash flow that you believe a hotel asset, you know, combined with the operational expertise can achieve. And you get comfortable with a debt level that cash flow can support. I think the reality, though, is those debt levels will probably have to come down for the serviceability to still be within a comfortable range. Sorry, was someone going to say something?
Please carry on, Hilton.
So it's not easy at the moment, because there's still a lot of uncertainty as to where, you know, inflation will bottom out. How long will the kind of curve carry on rising for? And ultimately, you kind of get left with with an approach of, you have to back the sector. You have to like hospitality assets. And I'm talking from a lender's perspective, of course. You have to be comfortable that the journey that hotel assets have come through in COVID, that they are on the road to recovery. And there's certainly blips along the way. But you do also have to paint that picture with a sense and touch of reality. Interest costs are going to be higher, and therefore the level of debt that you can comfortably put into an asset is probably going to have to be either structured differently or structured at a lower amount. And that I think is the position.
So with that in mind, then, what advice would you give to hoteliers right now on how best to service their debt?
So I meet with a lot of hoteliers, and I often give them operation advice, and they take none of it because because they're operators and I'm a lender.
Yeah.
But again, I think, in times like COVID, which are extenuating circumstances, and times of, that we're in now, huge uncertainty, good operators, entrepreneurs, good businesses find a way to be creative, to carry on pushing the revenue line, find new ways of generating revenue, find new ways to strip back costs. And again, from a lender's perspective, you're looking for those operators. You're looking for the parties that are trying to be proactive to the best of their abilities. Of course, there are, there's macro and micro effects and impacts that are out of everyone's control. But you're looking for those parties. And I think if you can see the opportunity in a lot of these transactions, just reference to kind of the M&A theme of this webinar, there is definitely opportunity out there. There's a wall of equity and liquidity chasing not just distressed assets, but good assets. Just, people, different entities sell for different reasons. Others buy at those times. They don't have to be in distress. But I think being open and transparent as to exactly what is achievable, certainly in the next 12 to 18 months from a revenue generation point, being realistic helps from a lender's perspective and underwriting, because ultimately we're looking at, the underwrite of a revenue line dropping down to a profit line, and then being able to get comfortable that the debt that we're putting into that is going to be serviceable from that. So again, just being realistic as to what really the situation is going to be over the next 12 to 18 months, and then giving plenty of time. It's a bit of a strange concept. OakNorth prides itself that we're much smaller. We try to be a lot niftier, and even we found that these transactions just are taking time because of the number of parties involved in a diligence exercise. And so to give, I think if I was looking to borrow money, I'd be looking to give as much time as possible to get the structure right, to access what debt there is out there on the best possible terms. And then just keeping the conversation as open and transparent as possible so that there's no surprises along the way. I think banks, by and large, have been very good throughout the COVID process. As Philippa and I suppose even Brad, from his point of view, the levels of distress haven't been there. There haven't been mass defaults, enforcements, because I think there's an acknowledgement that COVID was out of everyone's control, and people were trying to do the best they could do. That will probably change to a degree. There's only so long that a lender can not do something or kind of push the pause button, and operationally hotels are open and trading again. So I'm not saying we'll see a huge amount more of distress, but I think we will see more and more transactions being the after effects of a situation like COVID. And that will lead to opportunities both from an acquisition point of view and from a lending perspective.
And Louise, I think Hilton makes a great point in that as an operator, having great communication with your lender throughout the process, good times and bad, always will serve you well. And I think we saw that through COVID. I think, looking at your lender as your partner in this business and being able to communicate and talk about the plan, whether it's short-term or long-term, and whether it changes through the platform because you see an opportunity to do something, having that conversation, having that relationship, I think goes a long way, will always serve you well. And I think that's why there was so much success for operators during this past time.
Mm-hmm. I'd like to, as we're on the topic of operators, and maybe Brad, you might be able to lend some insights into this, but I'd like to call on the audience here, because if there are any operators tuning in, I'd really be curious to hear to what extent inflation is having an impact on the operation of your properties and what operational changes you're making to the business to counteract these challenges. So if anyone can would like to share some insights, please pop these into the chat and I'll read these out, which will be included in the replay when we follow up here. Brad, is this something that you could comment on now?
I think for us, we've always focused on long stays because of our service department background, that we're comfortable with and really understand what the guest who's staying for an extended period of time is looking for, weeks and months at a time. So for us, even when we have our daily stay hotels, we're putting in larger closets, we're putting in workstations, we're putting in places where people can feel comfortable. And so they're not coming for a day or two, they're coming for a week or two. And what we've seen is the person who maybe 3 years ago would fly from New York to LA for a 1-hour meeting and then come back the next day isn't doing that. They're doing this instead. So instead, instead of traveling once a month for 2 or 3 days, they're going once a quarter for a week or 10 days. And so making sure that your properties are set up for that accordingly makes a lot of sense. And what that allows you to do, combined with COVID, where somebody didn't want their room serviced every day anyway, it allows you to be a little more efficient in your operating model, and that longer length of stay does help reduce some of the expenses.
That's certainly been indicated by the trading performance at the moment. From a previous point, I'd say in terms of transactions coming to market, I think it's equally important to think about exit strategies. And some of the private equity have a short investment cycle. So you're going to also have an increasing number of assets coming to market for investors seeking an exit. So it's going to be an interesting time for sure.
Philippa, whilst I'm with you, is now the right time to sell? Is it a seller's market? And what's your forecast then on future valuations?
Well, at the moment, availability of stock is still quite limited. And so if trading's strong, and you have a willing buyer and a willing seller, then potentially at the right price, it could well be the right time to sell before other assets flock to the market. And that was advice. I do know that we were saying this last year as well, and it does certainly appear relevant still today. So. Is it the right time to sell? It depends on the individual situation, and if you need to sell or want to sell, then there's different reasons. But it's not a bad time to sell if you're at the trade, and the trading supports that. At the moment, you still not had. There's still relatively good visibility for trading months ahead. Yes, there's a lot of economic noise. But currently, it's still positive for the hotel market. There's still lots of demand out there. The pent-up demand is still strong. And so it might change with people's spending patterns and the discretionary spend. But from a seller's perspective, it's possibly a good time to sell.
Mm-hmm.
And I think, from our point of view, I would say what we've seen in the last 6 to 12 months are almost two types of sales. You've seen assets in good, almost strategic locations that have come to the market, and there's almost been a bidding war for them, which has pushed the price up beyond expectation, I think, from most perspectives. And then you've seen other assets which potentially have been underinvested in and need a bit of a capex turnaround. Now there's still opportunity in those, but I think it's a slightly more realistic expectation of purchase price there, because there the model, or there the opportunity has to work for the investor, who's then going to spend the capex plan and, to Philippa's point, do all of that, turn the asset around and exit within a certain period of time. The purchase price is the entry point. It decides whether that plan works or not. So there's kind of two halves to the market at the moment.
I think assets that are priced correctly will sell, and those that don't, then it's definitely, if there's not a repositioning play, then you need to be realistic, and as buyers are definitely becoming more price sensitive.
Yeah, I think that's right. And when I think those points are exactly right. When someone sells a property at a great number, there's a bidding war. Everybody else, not everybody, but a lot of people think, well, my property is worth that as well, when maybe it's not. So if they're realistic, I think there's a transaction. If they're unrealistic, from a seller standpoint, you might not have a deal. And from a buyer standpoint, if you're trying to steal a good property, you're not going to do that. You have to understand someone who has a great property, they know that typically, and you're not going to steal anything. So if the buyer and seller are realistic, I think you'll make a deal. If not, then the bid-ask spread is going to be a little too wide, and it will take some time.
Brad, whilst we're with you here, as an active buyer in the market at the moment, I mean, how do you see that buyer-seller dynamic evolving throughout the year? Philippa has just mentioned that we might see more price sensitive. So do you see that divide edging ever more closer?
I think it depends on the market. It depends on what you're trying to buy. If you're buying distress and you're buying someone's problem, then you have the ability to be a little more aggressive. If the seller doesn't have a problem, if they have a nice property, they have the ability to drive price, then you have to make a decision as a purchaser. Do I think, to Hilton's point, do I think I can buy it, do the work, what I want to do, and then still have room on the exit to have my profit? We think there will be opportunities to continue to be a buyer. We're at a point where we need to buy another 12 properties over the coming 18 months. So we will be an aggressive buyer. We think we'll be a smart buyer, and we think because we have the capital and we can provide certainty of execution, we think that will go a long way. I think, to Hilton's point, we're going to have to put in more equity, and I think proceeds will be a little more conservative, but that's okay. We're here for the long term. We're not looking to make something work because of positive leverage. So I think there are opportunities for us. I agree that you don't have to just buy distressed. There are really nice properties that will give you more of an upside than trying to buy something that maybe hasn't worked and you think that you can turn it around. We're looking at both. We're looking at strong markets, and we're very comfortable that we'll be able to buy properties over the coming months to fulfill our mission.
And lots of buyers last year, some of the big lifestyle type assets in regional UK that transacted, they bought purposely at the bottom of the cycle to get the benefit of the uplift over time. And just going back to your point on valuation, Eloise, if the current trajectory continues, where revenues keep pace with the uplifting costs, then we see at Knight Frank values to remain stable, we're optimistic that values will remain stable for the year, and that was we're on the same what we envisaged at the beginning of the year. We still maintain that momentum.
Yeah, I think part of this will be determined by interest rates. If we think we've kind of reached a stable level now, then that's one thing. If rates continue to rise dramatically, I think cap rates have to rise with them.
Mm-hmm. Brad, we've got a question here from the audience. Are you able to highlight the types of properties that you're looking for and which cities you're targeting? I mean, where are you seeing these opportunities? You're very much positioned in the lifestyle space. So I'd be interested to hear what you're seeing.
We're looking at properties from 100 keys to 1,000 keys in North America. So we spend time in Vancouver, Toronto, Montreal, and Canada. We're spending time, we're closing on a property in Boston, New York, Philadelphia, Washington, Miami, and West Palm Beach. We just purchased properties. We're looking in Los Angeles, in San Francisco, in Austin, Dallas, Phoenix, Tampa, Nashville, Atlanta. So throughout the United States, major markets, and we're spending time in London as well. That's our primary market in Europe right now, although we will widen that base if the opportunities present themselves.
Thank you, Brad. I'd like to come back to Philippa for my next question, please, as we've touched on the extended stay market throughout this conversation, and we've seen how some hotels have pivoted to this model during the pandemic, and there's been other additions of revenue streams, such as, say, the addition of ghost kitchens or streamlining F&B operations or adding a co-working element. But Philippa, what impact will the addition of such things to a hotel asset, what impact is that going to have on valuations and cap rates? And no doubt it must be quite difficult, I would assume, right now to give any kind of assessment or analysis as to what that might be, but I'd be interested to hear your thoughts.
I'm no qualified valuer myself. For cap rates, I suggest you pick that up with Karen Callahan, who's our head valuer. But in terms of the co-working or the extended stay elements, I mean, the extended stay companies are all bringing in these opportunities to enhance revenues in a greater way. Whether they actually some of the extended stay companies don't provide the F&B themselves, but it is the opportunity to extend your revenues, and as long as your margins are kept in check, then at the end of the day that should improve the returns that are available to them. So you're getting increasing lifestyle brands. I mean, lifestyle brands have evolved throughout a long period of time, but you're getting more and more coming offerings of the cheaper to develop and they're healthier, more select service, and more profitable in order to operate or to manage. So it's no surprise that you're getting the brands like Prizetel from and new Caption by Hyatt. They're coming, and they will continue to come. And I think this hybrid offering is definitely going to evolve, and it's going back to that extending of the revenues and to being creative. And you've got to be creative on the top line as well as the bottom line, and it will help. By doing that, you're going to preserve your values.
Thanks, Philippa. I'd like to hear almost the same question from a lender's perspective. So Hilton, taking into account what we've just talked about, I mean, how attractive is a hotel's proposition when they have all these additional revenue streams? And would you mind adding to your answer some of the key financials that you might require from borrowers? I mean, how can they become more transparent if they were needing, say, extra financing?
So to the question of alternative revenue streams, the longer stay market, I think it's a factor of COVID has forced operators to look at their assets and think, going forward, how do I maximize the revenue per kind of square foot? Is this model the best? Or is the kitchen and the massive breakfast buffet just a bit of a cost drain? And can I do something else? So that's a good thing, right? It's forced operators to think, how do I commercialize every bit of space I have, and am I doing that to the best? And it kind of, to a degree, it also comes down to building confidence. From a lender's perspective, you need to have, hotel lending is it's complicated, but it's also quite simple. You need to have comfort in the asset and confidence in the asset, and you need to have comfort and confidence in the operator. And the trend of a longer stay product, or dark kitchens, or streamlining F&B, that all gives comfort and comfort to the operator's ability to think differently, to look at the location of the asset, because some of these lend themselves to more city centre type locations. You're not going to take a resort product and have a dark kitchen and close down the kitchen and the organic garden type thing, because that's a big part of the revenue. So it helps to I think these are important elements, and I think that it's the duty of a lender to consider these other additional revenue streams, and even though they might be different to your conventional room revenue, which typically I think you base the most amount of comfort in from a cash generation perspective, to acknowledge that actually these are serious, these could be serious contributors to the bottom line in the future. And so it's our responsibility not just to write them off because maybe they haven't been there for too long, but to give credence to them. And in terms of the financials, again, that hasn't changed too much. You're looking at, to Brad's point, occupancy and room rate. It will always be the driver from a room revenue point of view. Your revenue management, systems and skill set will drive that. How you then build the check from a food and beverage perspective, to a degree, depends on your offering. Luxury, lifestyle compared to budget, and your location. I think there's an acknowledgement that they're trying to have too big a food and beverage line in a good location in a city centre where there are lots of cool bars and restaurants right next door. That's quite difficult to do. So why carry on doing that? Think of something else, be it co-working or something else. And then it's the cost conversion. So once you've built that revenue line in terms of your typical KPIs, room revenue, food and beverage revenue, spa revenue, your cost, your handling on cost, from a lender's perspective, I think there'll always be a huge amount of comfort placed on an operator's ability to demonstrate their handle on costs. Pushing the bottom line EBITDA margin, NOI margin that we kind of look for. So that's not too different from how we would have assessed transactions 2 or 3 years ago. And it basically comes back to those two factors: comfort and confidence in the asset, comfort and confidence in the operator.
Brilliant. Thank you, Hilton. We have fast approached our allotted hour for this webinar, so I'm going to remind the audience that if you have any further questions or you would like to connect with our Trailblazers, their details have been popped into the chat earlier in this webinar, and we're going to leave some time at the end for you to follow up on these. So please do carry on this conversation, as it's certainly a very interesting one. I'm just going to run you guys through some closing slides before we finish up today. And I would like to highlight the next webinar in the Trailblazers series is taking place in 2 weeks' time on Monday, the 11th of July, and it's called The Next Best Hotel Tech. And it's taking a slightly different format in that it's going to be a Dragon's Den style webinar. We have 3 dragons and 3 or 4 tech suppliers effectively pitching their products. So it's going to be a lot of fun. If you'd like to sign up to this webinar, you can scan the QR code in the bottom left-hand corner, or you can sign up using the link that has been popped into the chat. Now, I'm going to be at the Urban Living Festival next week, which is the 6th and 7th of July at East Winter Garden in Canary Wharf. And a session that is absolutely relevant to this webinar is the investor perspective. And during this session, the speakers are going to be discussing what's hot and what's not in a world of heightened geopolitical tensions, work and travel disruption, inflation, interest rate rises, ESG, debt leaving the market, and more. So if you would like to come along and hear and see what the Urban Living Festival is all about, for a limited time only until Friday, the 1st of July, I'm offering attendees of this webinar a 20% discount off ticket prices using the code that has been posted in the chat. And this code is also going to be included in the follow-up email with the webinar replay. So don't you worry, you will not miss out. And if you'd like to hear further information about the Urban Living Festival or any of the webinars in our series, please get in touch with my colleague Katie. Her details have been put up on your screen now. So all that's left for me to do is to say thank you. Thank you to our Trailblazers for sharing their insights, thoughts and opinions today. And thank you for everyone for tuning in. We are going to leave this webinar open for an additional 2 minutes for you to follow up on everything that we have popped into the chat today. But otherwise, I wish you all well, take care of yourselves, and I will see you in 2 weeks' time.